Everybody has an opinion of what you should be doing with your money, how you should be investing your money, how you should be saving your money, what you should be buying with your money, and where you need to be keeping your money. And if somebody has never done anything with their own money and they're telling you what you need to be doing with your money, you want to be very, very, very cautious with that. And this is where it can become a little bit difficult because the average person is broke. And the average person is doing very similar things. And now if you want to do something different and you start listening to what, let's just say, wealthy people do, that might require you to do something that everybody else thinks is weird. And this is where sometimes the popular opinion isn't the right thing to do. That's why I call what I do the minority mindset, because it's all about thinking differently than the majority of people. Because the reality is, if you keep doing what the majority of people do, you're going to end up like the majority of people, which financially is broke. And I don't say this to be funny or to just say this in general terms. I mean, statistically, the average person, the majority of people have no money put aside for savings. The majority of people are living paycheck to paycheck. And so if you keep doing what everybody else does, and if you keep listening to the advice that everybody's giving you, if you keep doing that, you're going to end up just like everybody else. And this is where you might have to do things a little bit differently. And you want to be very cautious with who you're getting advice from. I mean, one of the things that I say is never blindly trust a random guy on YouTube. I don't recommend you do anything because your goals are different than mine. Your risk tolerance is different than mine. Your time horizon is different than mine. Your investment education is different than mine. And what you're looking to do with your money is different than mine. And this is where you have to learn from different people, different opinions, and then find the best option for you. And you want to be very cautious when you're listening to somebody who has never earned any real amounts of wealth. And this is where also, if you're working with a financial advisor, I also want you to be cautious, because some financial advisors can be very good. Some financial advisors can be not so good. Because some financial advisors are just people making $75,000 a year by telling you what you need to be doing with your money when they've never actually achieved that wealth themselves. And so now, if you have a financial advisor, the thing that I always say is good. Nothing wrong with that, but you need to have enough financial education to know if your financial advisor is doing a good job or not. And you also need to look at how your financial advisor is being compensated, because if they're getting paid no matter what, whether you're losing money or making money, what is their incentive to make you any money? So you have to be very careful with the fees that your financial advisor is charging you, and you have to be especially careful with what type of advice you're listening from your financial advisor. This brings me to number 2, which is you don't want to be the person that's just stimulating the economy to make the economy function. Because in this economic system, the way that our economy works is the more money you spend, the more money somebody else makes. The more money you spend as Sweetgreens, which I just tried Sweetgreens not too long, very recently, and I've become a very big fan of Sweetgreens almost overnight. The more money you spend as Sweetgreens, the more money Sweetgreens makes. In order for the economy to grow, people have to spend more money. And we live in a consumer society here in America. Now, that's a good thing if you are an investor and a business owner, because people love spending money. But it's not so good if you are a consumer, because that means now if you do what everybody else does, that means you're spending all of your money and some with the help of credit card debt or home equity lines of credit or other loans, because people love spending money, which means you have nothing left to build your own wealth. And this is where I want you to understand that if you want to build wealth, you can't keep making everybody else rich. And the system is designed to get you to spend money. The best example that I can give you of this is just think of the stimulus checks. When the government sent out thousands of dollars with the stimulus checks to people, what were those checks intended to do? Were they intended to A, make you wealthy, or B, make other people wealthy? If you think they were intended to make you wealthy, we got to go back to understand, what does a stimulus check do? It's there to stimulate the economy. Meaning, give the average American money, because the government knows that the average American is going to go out and spend this money. And when the average American goes out and spends money that they got freshly in their pocket, that means Kroger makes more money. That means Amazon makes more money. That means Apple makes more money. That means Lululemon makes more money. That means Chipotle makes more money. That means Sweetgreens makes more money. And this is where now you have to understand that if the system is designed for people to spend money because it encourages people to spend money, everybody in the world wants you to spend your money. The government wants you to spend your money because that means it's going to grow the economy. And if the economy is growing, well, it's good for whoever's in power in government because then they can go out and talk about how strong the economy is and how they were able to stimulate the economy. So the government wants you to spend money. Wall Street wants you to spend your money because if you're spending your money, well, then Wall Street can show that their companies that they're invested in have higher profits and they're making more money, and the investors will see their investments soar. Corporations want you to spend your money because if you're spending money, that means Walmart's making more money. And if Walmart's making more money, well, that's good for Walmart, and that's why they want you to spend more money. The only person that doesn't want you to spend money is you. Because even your banker wants you to spend money because your banker wants you to spend so much money that you have to go into debt to continue spending money because your banker gets paid when you borrow money. And if you don't spend all that money, well, then your banker's not going to be getting paid. That's why now, if you are the only person that doesn't want you to spend your money, you have to now build that financial education to understand when it's okay to spend. Look, there's not a problem with you having nice things. I want you to have all the nice things. I just want you to be able to afford it first. That's the key. Because the system is designed to get you to spend money. But if you spend all of your money today, you're never going to have any money to build your wealth tomorrow. And what I'm saying is let's flip this up a little bit. Where now you spend your money to make yourself rich first, then you go out and make everybody else rich. And that's where now, hey, when you got the money, when you got the assets, go out and buy whatever the heck you want. If you want the Gucci, great, you can afford it. Your assets will pay for it. You want the BMW? Great, your assets can pay for it. You want a Rolls Royce? Fine, make sure you can afford it. There's nothing wrong with you wanting nice things. I mean, that's why you work to get money in the first place. That way you can have all the luxury, all the exotics, and live that life that most people dream of. I want you to be able to get that. But if you want to be able to actually afford it, that way you don't have to worry about money, and so you don't have to work until you die, that means now you have to actually flip the script and make yourself rich first. And if you're spending all of your money, you're never going to have a chance to make yourself rich first because you're so focused on making sure Amazon is rich. You're so focused on making sure Lululemon is rich. You're so focused on making sure that everybody else gets paid before you do. And if you want to build your own wealth first, you have to make sure that you build wealth first before you make everybody else rich. The third trap that you want to avoid is investing emotionally. Now, the reason why this is so important is because, well, for one, investing has become so much more accessible to people, which is good. Number two, financial news and education has become so much more accessible to people, which is good. Number three, people also trade on emotion. And sometimes they don't know how to decipher the emotion from investment, education, which is not so good. And so what we've been seeing happen is over the last few years, especially because over the last few years after the pandemic, we've seen a huge boom in retail investors, meaning regular people who have opened up their first investment account, their first investment brokerage, and have started making their own investments themselves, which is great. But without any sort of financial education, that also opens up a whole new world of hurt because people want to find the next hot thing. And now with the news and the media so accessible, people want to do what everybody else is doing because that's the natural human nature. And so when you hear of the next meme stock start to pop off, and you hear the news, you see CNBC talking about it, you see people on YouTube talking about it, you see people on Reddit talking about it. Now you get excited because you see that the stock has jumped 300%, and then you jump in and buy. Well, by the time it hits the news, you're probably too late. And then when things start to turn around, and whether it's a meme stock or anything else, that's when people start to panic. They start to sell. They start to get scared. They don't want to lose money, and so they sell. And so now instead of buying low, selling high, you're buying high and selling low. And this is why the average person ends up losing money in the stock market when in reality, the stock market has grown over the last 100 years. This doesn't mean that the stock market has only gone up. There's been many periods, many years where the stock market has gone down. But the people who have held long enough to good investments were able to make money again and again and again because you hold through these cycles. And you can never do that if you're investing emotionally. And unfortunately, the easy access to stock brokerages and the easy access to all the information on the internet is a double-edged sword, where if you use it the right way and you learn to get educated and you learn how to invest your money smartly, you can build way more wealth. But if you fall into the emotional side and you just want to get into the get-rich-quick schemes and you want to find the quickest way to make a lot of money, I mean, who wants to get rich slowly? When you do that, well, you also risk losing all of your money and more because now you're following your emotions instead of following your finances, and also because a lot of stock brokerages make it very easy to trade on margin. Margin is debt. And so now instead of investing the $1,000 that you have and thinking, man, if I could double this $1,000, that would be great, you can invest $5,000 because now your stock brokerage is going to give you all that extra debt, and now you could double your $5,000, make a whole lot more money, but now you can lose all that money and some, which is why if you're going to be investing your money, you want to understand that number one, long-term investing is where the real wealth is built. Number two, never invest more than you're willing to lose. Number three, understand that investing has risks. You're never guaranteed to make money when you invest. In fact, you will probably lose money at some point, which is why you want to never blindly trust a random guy on YouTube. And four, understand that patience is a huge key to building true long-term wealth instead of being the person that's always trying to chase the next hot stock. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.